Welcome, financial professionals. I'm Brady Serold, Senior Vice President of Disability Income here at E4. Thanks for joining us on The Brew, where we build relationships and empower wins. Today, I'm here to provide you with a conversational approach to income protection and how it might lead to a potential guaranteed standard issue opportunity. Appreciate you joining the conversation today. Positive cash flow. Every financial plan is predicated on one thing: positive cash flow. Is the money machine adequately protected? And who is the money machine? It's your client. I said they are their biggest money machine. I was asked somebody, if you had a money machine worth $4 million in your garage, would you insure it? Sure you would. That's your client, potentially, and their lifetime income. Remember, insurance is not your plan. Again, we talk about disability, and I hate those words because I don't think anybody believes they're ever going to become disabled. You sick or hurt and can't work. I said, I think people think at some point during their working career they could become sick or hurt and might not be able to work. Again, having the plan, it talks about asking that simple question: what's your plan if you become sick or hurt and can't work? Stop talking. Let them go. Remember, insurance can help fund the plan, but it is not your plan. So we kind of look at the plan, and one thing I've kind of broken it down to 5 basic things in the last 30 years of doing this that people need to address. And I don't care if you make $50,000 a year or $500,000 a year, everyone has these same 5 basic needs. You have to have a place to live. You got to eat. You got to pay your utilities. You have to have transportation. You have to have insurance. And then there's that thing called lifestyle. Everybody has a different lifestyle. And again, you've worked hard to get where you're at. Do you really want to take a step back? But I think the main thing is we have to make sure those first 5 things are covered. And then, need and budget will depend upon your lifestyle and what we can cover. So you kind of look at how we're going to pay for this plan. Again, we talk about savings. I think our savings rate in our country is less than 1%. So if you do have a client who has saved a significant amount of money, that might be a source. But again, that might be the short term. Maybe if you can't work for a week, couple weeks, maybe your savings and your investments might be able to hold you over for a couple months, 6 months. You have your 401k. Probably not a good thing to take because you got potentially penalties and interest. And in addition to that, that's for your retirement. Do you really want to spend your retirement dollars during your working years instead of during when you want to use them when you retire? You can sell items. So again, you're selling things that you've accumulated at some point in time, but you're selling them when somebody else wants them, right? Is that a good time? Typically, you don't get high dollar when you need to sell them. It's when you want to sell them. Again, you can change lifestyle, kind of laugh at that. Make that one comment sometime. The doctor said one thing to me that's kind of stuck forever and said it, but prior to becoming disabled, my wife liked nice things. His joke was, guess what? She still likes nice things. So, lifestyle, again, you've built it, you've earned it. You've grown there, your family's become accustomed to it. Do you really want to have to take a major step back? Then there's the government. Well, I don't think you want the government handling your your income stream. But if Social Security, if you do happen to qualify for it, remember the definition is totally disabled from any occupation. There's a 180-day waiting period on it. And right now, I think the average Social Security payment is about $1,200 or $1,300 a month. That is taxable. And the average wait time is right now over 500 days for that decision to be made. So again, if you do get that sort of money on top of it, I look at as cherry on top of the ice cream on Sunday. And then you have the 2 we're kind of going to talk a little bit about more today, the employer disability coverage or long-term disability. And again, if your employer does have that, about 30% of all employers have some form of long-term disability, which they categorize as typically 90 days or longer. And then there's the personal income protection, the individual disability insurance. Let's talk a little bit about the employer disability coverage. Again, it's a benefit you receive through your employer. If it's employer paid, again, you're not seeing what the premiums are on there. However, they could be voluntary in nature, where you have the opportunity to participate for it. Again, I asked even my kids, hey, when you got a new job, let me look at your benefits. Let me take a look at it, because if something's voluntary, you might only have one opportunity to take it. So at least being able to understand what it is. But again, you might pay for it, or there might be a cost share. It might be a gross up where the employer is imputing those wages or the premiums into your wages. Therefore, the benefits received would be tax-free at time of claim. Again, you have to be a member of the group. Again, that's the big thing. So it's an agreement between the employer and the insurance company. The individual has nothing to do with it. So you have no choice on anything. But the advantages are, they have short-term and long-term. You typically don't have to provide insurability. So regardless of your health, once you become an eligible member, assuming if it's not voluntary, you are done that. And then the premiums are low. And that more comes in terms of if you are paying for that on your own from a voluntary standpoint. The disadvantages, again, I talked about that limited choice on structure. It's the plan, and that is the plan. You don't have a choice on any sort of definition within the plan itself. Might not cover all your earnings. Again, most group plans, probably 90%, only cover base salary. So, does your client have incentive compensation, meaning bonuses, commissions, restricted stock options? There's other forms of compensation. So again, when a client may think they have 60% of their income, do they really? Again, that might not cover all their earnings. Remember, this is an agreement between the employer and the insurance company. So when your employment ends, the coverage ends. Does your new coverage company have that same sort of coverage? Are you healthy enough to get coverage at that time? So again, less liberal definitions. Again, it has a 2-year, typically has a 2-year own occupation, and then not working in and then the ability to do any occupation in the national economy, and the ability to earn 60% of what you earned before. So the insurance company makes the determination if you can do something else or not. It's not your choice. Has limitations on mental, nervous, drug and alcohol, musculoskeletal, subjective conditions. So hits that. There are offsets in the plan for Social Security, any sort of lawsuits. So if you get in a car accident, have some sort of disability settlement out of it, the insurance company will potentially reduce your benefit. I talked a little bit earlier about the taxability of that. If your employer pays for it, it's taxable. So again, we talked about, hey, if you had 60%, do you really have 60%? Let's take a look at it. Let's look at their summary plan document and understand. And then, it kind of goes to, if LTD is not enough, again, you've determined what their plan is by looking at their 5 basic needs plus whatever they wanted to cover from lifestyle. If it's not enough, you really have 3 options. You can do nothing. And I love this quote from Ben Feldman, doing something costs something, doing nothing costs something. Sometimes doing nothing costs more than doing something. In the case of disability, if you're not adequately covered, doing nothing definitely costs a lot more than doing something. You can apply for coverage through a personal advisor. Again, that's when we talked about that personal individual disability income. Again, most advisors don't sell it because it's not an easy product to underwrite. Again, it's that personal product. You have underwriting criteria set by the insurance company based on occupation, health habits, avocation, income levels, et cetera. So there is a pretty rigorous, underwriting process. And again, that comes into the disadvantages. The underwriting, it's not easy. Again, they don't insure all occupations. If you already have pre-existing conditions, now they can use exclusion riders. So if somebody had, a bad back, they could exclude the low back, or maybe if they're a little bit too short for their weight, maybe that from that standpoint, they might put an extra premium rating on it, similar to the life insurance side, might limit the benefit duration, maybe a multitude of conditions that would require changes in the contract. But again, they do take a look at those sort of things. But the advantages are benefits are tax-free typically. In your features, you can have and then go through all these all the different features, but, the true own occupation, pure own occ, unlimited mental nervous, meaning your drug and alcohol and stress, anxiety, depression is covered like any other disability, have an extremely strong residual and partial, even in recovery benefits in some of them, where if you go back to work full time, but still suffer a loss of income because maybe you were that commission based and you're trying to build your inventory back up, like somebody like a financial professional, or maybe you lost patients, you're a dentist and you're trying to build your practice back up after a period of disability. As long as there's still 15 or 20%, depending upon the carrier, loss of income due to that previous disability, you can still collect the benefit. There's catastrophic benefits, and catastrophic benefits are if you have 2 of the 6 activities of daily living, or a severe cognitive impairment, an insurance company will pay you an additional sum of money. So look at it kind of as long-term care during your working years. It's not a substitute for a long-term care policy, but it does provide those sort of benefits, because what 30 or 40-year-old is looking at long-term care? Not very many. Most of them, if you're 30 or 40, your parents might be getting to that age, but if your grandparents happen to still be alive, they are probably at that age where they're potentially using or have already used long-term care. So, again, that catastrophic benefit, a cost of living. So when you're out on claim, do you want your benefit to go up? Again, just different things. Again, it's most comprehensive. The other part is premiums can increase. So once you buy your policy, they can't change the premiums on you if you have the non-can and guaranteed renewable. Again, and you can't lose that coverage again, but it is expensive, and you do have to go through underwriting. So then the last one we talk about is guarantee standard issue. It's kind of the buzz in the industry right now. So what is guarantee issue? It's not a product. It's a simple underwriting approach that makes individual disability income coverage available to a clearly defined class of employees without medical underwriting. Pretty simple. Again, no medical labs or exams required. Again, part of that they hate, don't have to get stuck or, go take a look. They don't look at any health history. So, in the case of, maybe you had a bad back, they're not going to go to your chiropractor. They're not going to get your height and weight, that sort of thing. There's no personal financial documentation required. When you look on the individual side, typically they require, depending upon what you are, at minimum a pay stub or last year's W-2. But for most amounts, it's 2 years tax returns and all supporting schedules. Sometimes if you're a business owner, they want business taxes as well. So that's pretty, intensive for information needed. Remember, no ratings or exclusions on the policies. Policies issued as applied for. Common policy structure and replacement ratio. So that's the one thing with the guarantee issue, which is similar to the group side. The policy structure, meaning what features and benefits are in there, and then the replacement ratio, that's set at the employer level, not at the employee level. And then portable policies, with a permanent discount, so, kind of where you go in here is, maybe that individual that you're talking to might be a key employee. Maybe they are the business owner, and they might be less insurable than what they could be to get a standard policy, bringing this up. Or maybe they're an executive in a company and, they have some health history, or, they want more coverage, and maybe you get that opportunity to go in and say, hey, how many other people at the company are like you? Being able to talk about guarantee issue gets the person who understands that they need it themselves, but maybe they can't get it at all, or maybe they can't get what they would like. So kind of go through the advantages of a guarantee standard issue program. Again, for the employer, it's that benefit equalization or reward program. So, when 60% isn't 60%, the CEO might have a 30% replacement ratio versus the receptionist has a 60% replacement ratio. Is that equal? Sometimes companies say, hey, we treat our employees equally. Well, sometimes in the benefit world, they don't, because benefits are meant for the masses, not the highly specialized. Or sometimes they do a reward plan, and maybe the employer says, hey, you know what, we're going to cover your uncovered compensation, but we're also going to help cover some of those taxes that you might have in the event of a disability. So they'll maybe issue a 70 or a 75% overall replacement ratio on top of a typical group plan. Remember, the employer can carve out based on classification. So they can discriminate as long as there's a clearly defined class. It also helps employees recruit and retain valuable employees. So people leave for benefits these days. So if you have a super strong disability plan, an individual who might have some health issues might not choose to leave your company. Again, in the premiums for these plans can be paid for by the employer or the employee, and they might be tax deductible to the employer. For the employee, again, I think we kind of talked about it in the last slide, but in strong contractual provisions, they're individually owned policies, fully portable with all the discounts that go with them. There's no reduction. So again, that strong combined group with an individual plan. Kind of going to where the target markets are. You kind of look at the white collar type businesses, accountants, architects, advertising, sales, the technical places like, engineers, attorneys, even you look in the medical market, the specialized physicians, or even the non-professional services, looking at veterinarians, et cetera, or the high tech area. So again, a lot of different things. I mean, it's really not meant for the hourly employee. Kind of look at what makes a strong case here. Typically it's the demographic is about 50% or more male. Now, again, our workforce has changed and the carriers are getting a little bit more aggressive, but, they're making some offers. Now, sometimes the discounts, they have to make some changes in it, but, typically I'm just looking at what might be the strongest case, that white collar management executives, professionals, average age, they like to look at typically less than 53, 55. Group benefits, the lower the group benefit max and the differential creates the better case. But again, on bigger cases or higher incomes, you could have 10 or 15,000. Typically looking at that group plan that covers base salary only, where maybe only a select group of individuals have some sort of performance meaningful incentive compensation. Go kind of looking at that. You're looking at your insurable income under this plan, your W-2, which is your bonuses and commissions. Sometimes they can look at stock options and some other forms of compensation on a case-by-case basis. Minimum income tends to be around $75,000 because that's when in conjunction with group plans. Now you can do a standalone plan, but most of these are in conjunction with group. It's $75,000 of income because that's kind of where a meaningful benefit is. And then look at the stability of the business. They don't want a new startup business because, again, the likelihood of business failures in the early years is pretty high. So they're kind of looking at least 2 years being stable in business. Then you put how to get it done. Again, first, identify the prospect. So again, do you have an individual who might be, and then what other individuals do they look like? Or maybe you have an employer and you want to show this to them. Maybe it's a group of partners. So again, let's identify the prospect and the eligible class. We would need the summary plan document, which basically is all the details of their group plan and understands the workings, as well as the census. That census would have name, some sort of name, the client name or identifier, date of birth, gender, state of residence, job title, and if there are some duty pieces, we can take a look at that as well. Annual salary, and we want that annual salary in addition to any 2-year bonus or commission or incentive compensation. If there is only 1 year available, the carrier will typically take 75% of that number to determine an eligible benefit. So those are the two main things that we need to consider a group. And then what we'll do is we'll take it out to the carriers and we'll look at potential solutions. And that could be reward, that could be benefit equalization. Again, just depends upon the data in the census and what might be a potential option to show the employer. If they say, hey, that looks good, then basically we accept and enroll. Many of these plans are census enrollment now, so there is no need for a personal application. Everything is done at the employer level, so it's relatively easy. It's 1 day actively at work. In some of these plans, you can go down to 3 lives. Now, on the lower lives, under 10, some of them do require 90 days actively at work, and they'll take a look at tobacco for that standpoint. But if you get an employer enrolled based on census, there's no tobacco rates. There's 1 day actively at work, and everything is driven from the employer data. But at the end, each employee does get a policy. So it's a relatively quick process once they make the determination. And then the administration, again, these plans, we help here at E4 administer those plans. We have Aaron on our case management team who's works with me and the carriers, and every year even as new people are added to the case, we assist the employer doing that. If somebody leaves, they can take the policy with them, so we help the portability of that product. Every year, if they have income increases, we go back and work with you as the advisor and the client to do that. So, help with billing, whatever you need, we have the case management team to help you do that. So then lastly, I think what's important is, what's in it for the advisor, I think the easiest one, you'll have multiple policies and minimal underwriting. I think who wouldn't want 5 policies instead of 1 with no underwriting? Because again, if you take one person through underwriting, a long time ago, I started my career as an underwriter, but I would say if I had a room of 10 people, I would probably say 3 or 4 are declined. 3 or 4 of the other ones have something wrong with them that wouldn't get a policy as applied for, which leaves you with 2 or 3 people that might get a policy as applied for. Versus this way, everyone's getting a policy as applied for, again, with none of those questions or issues. So the initial revenue you're going to get, the traditional compensation, again, depends on the discount on the case, but higher first year commission in the initial revenue. Now, in some of the smaller cases, the carriers who are in that marketplace do level commissions. But again, it's a strong first year comp. And then you have recurring revenue. And not only do you have the renewal compensation, because traditional individual products typically have some form of renewal compensation from years 2 to 10. That's still from the initial enrollment. But then every time you add somebody new to the plan, you get first year compensation on that, as well as renewal compensation as long as the plan stays in place. On top of that, you have the annual review process that I talked about in the service side of it. And on those annual reviews, every time somebody gets a bump up in income, the carrier will take a look at it and bump their policy up, and you get first year and renewal comp on that. So, once you start doing these sort of policies, it can really become an annuity for you. And then you look at vested commissions. Unlike group policies, the traditional group, you can get agent of record tomorrow, and all the compensation and all the work you did goes away. On the individual plans, however, once you've put a policy in place and it stays in place, the writing agent always remains commissioned, even if they're not agent of record. Someone could take agent of record and potentially get the increases that I had mentioned a little bit earlier, but the initial commissions and anything in place would stay in force. And also, from an individual standpoint, it's hard to replace these plans because they're age-based. So if somebody comes down the road 4 or 5 years, the ability to replace it is tough because of increased ages. So these, once you put in the plan, these tend to be pretty sticky. And then lastly, it's the cross-selling opportunities. I mean, again, maybe your client was the chief financial officer of this company, and he or she didn't introduce you to the other executives. You now have the opportunity to sit in front of them and talk to them about the other things you do as an advisor. Or what we've also done quite a bit with these guarantee issue plans is we've put in guarantee issue life plans. So again, you can, with one carrier in particular, if you have a guarantee issue plan or another one of their products, you can do a guarantee issue, be considered. Now, mind you, it has to get approved by the carrier, but you can go down to 5 lives and get guarantee issue a 10 or 20-year term. So again, to maybe get another $500,000 of term on some key employees. Again, if they're potentially less than insurable, it might be a good thing, and that can be used either for key person or executive bonus purposes. So again, lots of cross-selling opportunities for these type of plans. So why E4? I think you got the support team. You have your regional VP who you work with, and your normal case manager. You have my help, and been doing this for over 30 years, so know a few things about it, and we have great relationships with our carrier partners. And then we have our case support specialist, and that team really helps you manage and monitor those cases moving forward, and help set the expectations with your clients. We have the Choose Your Journey. Again, provide step-by-step instructions to help you. We can walk alongside you, serving as your guide. Or if you want us to help run the case for you, we're happy to do that as well. You kind of look at the carrier lineup. In the white collar world, our products were Ameritas, Mass Mutual, Principal, the Standard. In the guarantee issue world, you kind of add in Guardian and Unum in that world. And we go down to the True Work site. On the disability side, it's Illinois Mutual. On the life side, we also have Cincinnati Life. The blue collar, you get more manual type duties. We have a surety in Illinois Mutual, and then we can even move to the specialty and excess and impaired risk markets with Lloyd's of London. And again, that can be guarantee issue as well in that. So if you have super high incomes where maybe the amounts the carriers between the LTD and the individual guarantee issue plans aren't adequate, there are some options above and beyond that through the Lloyd's of London marketplace. Again, thank you for spending time with us today. May 21st, we will be discussing 2 actual case studies on our third Thursday at 3. So please look out for that registration link. If you're interested in viewing this and past episodes, please subscribe to our YouTube channel. We release one the first Wednesday of every month. Next month is Annuity Awareness Month, and our brewcast will be hosted by none other than Doug Twitty, the Sultan of Annuities, and partner here at E4. It will be released at 10 a.m. on June 3rd. Thank you for tuning in, and we'll see you next time on The Brew.